Hi everyone, and welcome to another video where we are getting started with section C of the FM Pre-December 2025 mock exam. So here in this video, we are going to talk about the very first case study of section C, which is Banbury Company. As I can see, I can have a quick look at the requirement and find out that I'm supposed to find out the weighted average cost of capital. This means that this question tests me over the cost of capital unit from our ACCS syllabus. Now, I know that for the 10 marks in this particular requirement, I'm supposed to find out the market value weighted average cost of capital for Banbury Company. So I can say that this is a solution for part A, where I will be calculating the market value after tax weighted average cost of capital of Banbury Company. So this is the requirement which I'm supposed to answer. Now, when I read the case study, this is what I'll keep in mind, that my eyes will look for the information which will help me solve this particular requirement. So let's read the scenario. The statement of financial position of Banbury Company includes the following information. Equity finance, I have ordinary shares worth $20 million in nominal value. One share is worth $1. Reserves are worth $15 million. Non-current liabilities, I have 7% convertible loan notes and 5% preference shares that I have issued. Banbury Company has an equity beta of 1.3 and the ex-dividend market value of the company's equity is $80 million. Ex-interest market value of the convertible loan notes is $18 million and the ex-dividend market value of the irredeemable preference shares is $5.5 million. So they've basically given me the total market values for all of the three sources of finance which Banbury Company is using, making my job slightly easier because now I do not have to struggle to find out the market values of the different sources of finance which they are using. Now, proceeding further, the convertible loan notes of Banbury Company have a conversion ratio of 20 ordinary shares per loan note, or they are redeemable at par. The conversion date and the redemption date are both on the same date in 5 years' time. The current ordinary share price of Banbury Company is expected to increase by 4% per year for the foreseeable future. The equity risk premium is 5% per year and the risk-free rate of return is 3.5% per year. Banbury Company pays profit tax at an annual rate of 20% per year. So I have all the information that I need to be able to calculate the market value weighted average cost of capital for Banbury Company. So what I'll do is I'll first find out the costs of the different sources of finance which Banbury Company is using. So what I can do is I can create a rough layout for my final answer, wherein for my WACC I will first lay down the source of finance which I'm talking about. So firstly, let's talk about ordinary shares. Then I will consider for my convertible loan notes, and then lastly I will talk about my preference shares. So for all of these sources I need to know the cost of capital for each of these sources individually. Post that, I need to take out their market values, which I can then use to find out the market value weighted average cost of capital. Market values are already given to me, so I can enter them already. Ex-interest market value of the company's equity ex-dividend is $80 million. So I can enter 80 over here. With respect to convertible loan notes, it's $18 million. And with preference shares, it's a $5.5 million that I have in terms of market value. Now, what I will do now is find out the cost of capital for the different sources which I have with me. So now for cost of capital, I'll create working one. First, I'll find out the cost of equity. So for cost of equity, I know that the sort of information that has been provided to me, I can use the CAPM model to find out my cost of equity. Using the CAPM model, I know that my cost of equity is the risk-free rate plus the market premium, that is the expected return on the market minus the risk-free rate into the beta. So I have all the information I need for this. That means my cost of equity is going to be equal to risk-free rate is given to me as 3.5%. Then they are already giving me with the premium. That means I do not have to subtract 3.5% again. So I'll take 5% multiplied by the beta, which is given to me as 1.3. So into 1.3 is what I multiply it with. And this is how I'm able to work around my cost of equity. So my cost of equity comes to 10%. What I can do is under the cost of capital, I can link it to this particular working to tell my examiner where did I actually get this number from. Now I can create a separate working number 2 wherein I will show how to calculate the cost of the preference shares. So for the preference shares, I know that the formula that I've learned is I take the dividend per share divided by the price per share. I know that the KP will be equal to D divided by the P0. So I know how much dividend will be given. $1 is the nominal value, 5% is the dividend. So with that, I get to know that dividend will be equal to 5% into $1, which will be 0.05. But now I also need to know the P0. So for finding out P0, I am given with the total market value of the preference shares, which is $5.5 million. Now, if I divide this with the number of shares, I will be able to find out the value of one share. So how can I find out the number of shares? 10 million is the total value and $1 is the nominal value. That means the number will be 10 divided by 1. That is 10 million number of shares. So that means 5.5 million divided by 10 million will give me the price of one preference share of the company. So with this, I can now finally calculate the cost of preference share, which will be dividend divided by the price. So if I convert it to a percentage, it's roughly 9.09%. So I can link this particular working also to the cell of my working and tell my examiner that this is how I arrived at this 9.09% figure. Lastly, I need to talk about the cost of the convertible loan notes. So working 3 is where I talk about the cost of convertible loan notes. So I know that I have to take all of the cash flows associated with these convertible loan notes, and then I have to find out the IRR of all of the cash flows. So what I do is I plot all of the years, year 0, 1, 2, 3, and these are redeemable at par in 5 years time. So I plot numbers till 5. Right now, let's see how much is the market value. They're telling me that the convertible loan notes are worth 18 million worth in total, and I have 20 million divided by 100. That will give me the number of loan notes. So first I find out how much will be the number of loan notes. So for the number of loan notes, I can simply take the total worth, which is 20 million, divided by 100, which is the worth of one loan note. So that means I have 0.2 million loan notes in issue, number of loan notes. That means if the total value is given to me as 18 million, value of one loan note is going to be equal to 18 million divided by the number of loan notes, which gives me $90 as the value in the market. So equals minus 90. This is how I'm telling my examiner that I've calculated my market value of one loan note. Now, every year you are going to take the post-tax cash flows to find out the IRR. So every year they are paying an interest of 7% on these convertible loan notes. So if you talk about how much it will be post-taxes, you can simply multiply it with 1 minus the tax rate of 20% per year. That means $5.6. This is the amount of interest which the investors are going to receive for each of the years. Now, in the 5th year, because these are convertible loan notes, that means my investors are going to receive a choice whether they want to go for redemption or they want to go for conversion. So in the 5th year, the choice that the investors will have is choice number 1, and then they will have another choice, which is choice number 2. Choice number 1 for them will be to get them redeemable at par. So redemption at par, that means they're going to get $100. Second is they can get conversion where they are going to be getting 20 shares per loan note. And if you talk about how much the share price looks right now, so if you see the total market value of the equity is given to you as $80 million, and they're telling you that 20 million number of shares are there in issue. So current market price per share can be calculated using 80 is the total worth divided by 20. That's the number. So that means $4 is the value per share. Now these shares are going to rise by 4% every year. So that means the share price, if I want to calculate after a period of 5 years, this will be worth this much. So that means 4.86. This is what the price of the share 5 years later. So that means as an investor, when I'm choosing to get 20 shares, this is the worth that I will end up receiving, 97.32. So as an investor, will you choose to receive $100 or will you choose to receive 97? Obviously, any rational investor will choose to receive $100. So you take equals 100 plus the interest of the last year. These are the post-tax cash flows which are associated with these convertible loan notes. Now, what I want to do is I want to calculate the IRR of all of these cash flows. So I use equals IRR formula, select all the cash flows, hit enter, and this is what is going to give me the cost of these convertible loan notes. So 8.11%, this is what I will put equals to over here and link it to this particular cell. So 8.11%, this is what I enter over here. And then lastly, I can use the WACC formula to arrive at my market value weighted average cost of capital. So I can do one more thing. I can calculate the totals over here. So the total of the market value, I can use equals sum formula. Select all three values, hit enter. This is the total market value of my company, compiling all the sources of finance which the company is using. Now finding out the WACC of the company, the final answer will be equal to, if I take the proportion of capital multiplied by the cost of the capital. This is the first part. Second part, I want to take convertible loan notes cost into the value of the loan notes. Plus, I want to take the cost of the preference shares into the market value of the preference shares. This is my numerator. I can put another bracket so that my numerator as a whole is separated. And then from the denominator, I can simply take 103.5, which is going to give me my weighted average cost of capital. So as a business, 9.62%, this is how much is my weighted average cost of capital. Now, this is how I will be framing my answer for earning 10 marks that are possible over here. I was trying to just make it bold. So this is my WACC and 9.62%. This is what my final answer looks like. So I've bolded my final answer so that the examiner is able to find out that, yes, okay, this is my final answer. What I can also do to improve my presentation a little bit is to format and, go to the cells wherein for my the way that it looks, I can put borders around the cells, and you just click on all of these, select one border, any that you like, click on all of these cells one by one so that all of the cells are going to look like a table. So you've put in the table and this is the final answer of WACC that you are getting. So here we have solved the 10 marks of requirements where we had to calculate the market value weighted average cost of capital for Banbury company. Now moving forward to the second question, this was I was just showing a demo to the students. Let me just reset it. Yeah. So part B, we are supposed to discuss why the market value weighted average cost of capital is preferred to book value weighted average cost of capital when making the investment decision. So what I've done is I have already drafted an answer for you people, which I will just bring over here so that we can discuss how we are going to draft answers like these. So give me a moment while I do that. Okay, so let's discuss the part B, wherein we were supposed to discuss why the market value weighted average cost of capital is better than the book value weighted average cost. So if you see the answer that I've broken down for you people, this is in very simple terms. This is something which you can frame on your own also. So the very first sentence, if you read, market values are preferred. Why do we prefer market value? Because market values are more realistic, they are more current, they depict what the current company's cost of capital is going to look like. Book values are something which are not updated, they are not up to the date, so they cannot tell you realistically what will be the cost of capital of the company. Again, if you use book values, you will most probably understate the proportion of equity. How? Because usually if you see comparison between debt and equity, equity is something which is very highly valued in the real market, but in the book values it's very low. So if I use the book value WACC, then I will be significantly understating the proportion of equity in my capital structure. As a result, I will be getting a very lesser book value weighted average cost of capital, which will not be accurate for the company. Third statement that you see is, as the cost of equity exceeds the cost of debt, the understatement will lead to a generally lower WACC. That is what I was just telling you people about. And lastly, if my WACC is understated, my actual cost of capital is higher, but according to me, my WACC is, let's suppose, 10%. So maybe I accept those projects which give me an IRR of more than 10%, but because I was using book values, my WACC is understated and actually my WACC is 15%. So I may end up taking wrong investment decisions because of using the book value WACC, and this will not help me maximize the value for my shareholders. So underestimated WACC will give me a lower discount rate, which I will use in investment appraisal. As a result, I may accept projects which do not really add to the value for the shareholders. So this is how you will answer in very easy terms, just to convey the meaning as to why market value is better and book value WACC cannot be used. Now moving towards the part C, which is the last part from this discussion, we're supposed to discuss 3 attractions to Banbury company of convertible debt compared to a bank loan of a similar maturity as a source of finance. So if you talk about these two sources, convertible debt is also a debt, and then if you talk about bank loan, that is also a source of debt. So why will a company prefer convertible debt over a bank loan? You have to give 3 reasons. For you people, I've given 6 reasons, so we can discuss all of these reasons together, and whichever 3 you people like, you can choose those reasons. So for the very first reason, you people see lower rates of interest. Why? Because when you're giving the conversion option, you're already adding some extra value to the investment of the shareholders. So that means you can offer a slightly lesser rate of interest. So your cost will be lesser. That is why you will prefer convertible debt over a normal bank loan. Then the second possible reason is there is also a possibility that you will not have to redeem. How? These are convertible loan notes. So if, let's suppose, the investors choose to get it converted, you will no longer have to pay cash to redeem those loan notes. But if you opt for a normal bank loan, you will have to pay cash back to the bank. So that will require a very good cash management planning that you will have to do. In contrast, a bank loan has to be repaid in full, requiring a very careful cash flow planning. Talking about the third aspect could be about the security requirements. So usually if you go for a bank loan, they will need some asset as a collateral for security. But if Banbury company may not have any security available, then again they will prefer these convertible loan notes, because you do not have to offer any security for issuing these loan notes. Talking about the fourth aspect, another reason why companies will prefer convertible loan notes over a normal bank loan is the availability of finance. How? If you talk about convertible bonds, many investors will be attracted by convertible bonds. Why? Because some of them may also be interested in getting converted into equity. So that's the reason why a few other investors will also get attracted when it comes towards the convertible loan notes. But banks, on the other hand, will only give you money when you give them collateral. So multiple people would be willing to invest in the convertible loan notes, where bank loan can be difficult to obtain. You can only get it if you have security. So this also makes it more preferred for the Banbury company. Another aspect is the impact on gearing. So initially, if you take bank loan, if you take a convertible bond, both of them are at the end of the day instruments of debt. So they will both increase your gearing. However, if your bonds are actually opted by the bondholders to get converted into equity, then they will form a part of the share capital. That means debt will no longer remain in the debt section of your balance sheet. It will come in the equity segment, which will decrease the proportion of debt in your share capital. As a result, your gearing will also decrease. That's a good thing for a company. And lastly, if you talk about the another factor, that is the depressed share price. So maybe if right now Banbury company thinks that the share price is very low, we do not want to dilute more of our ownership at such a low price. I do not want to give up my ownership in the company to some other shareholder at this low price. So what I do is I get an alternative in the form of a convertible bond. How? I am able to raise the funds also, and I can delay issuing shares to the investors till the time the price recovers a little bit, so that the equity will be diluted at the end of the day, but I will be getting a good price for it. That is what is another factor which makes the convertible loan notes more preferable compared to a normal bank loan for a company like Banbury company. So with this, we have come to an end to the very first question of section C in your FM pre-December 2025 mock exam. This was Banbury company. I'll see you in the next video, which will be the last video for this particular mock, where we will discuss the last question, that is the question number 2 of the section C of this paper. I hope that these videos have been helpful to you. I'll see you in the next one. All the very best to all of you.